Good morning and good evening, ladies and gentlemen. Thank you for standing by and welcome to the BEST Incorporated's first quarter 2020 earnings conference call. With us today are Johnny Chou, BEST Inc.'s Chairman and CEO, and Jenny Pan, Principal Accounting Officer. Through today's agenda, Johnny will give a brief overview of business and operational highlights. Then Jenny will explain the details of financial results. Following the prepared remarks, you may ask your questions. Please note this conference is being recorded. Please also note this call is being webcast on BEST Inc.'s IR website at ir.best/incorporated.com. A replay of this call will be available after the call. Investor presentation is also available on the IR website. Before it begins, I will read the safe harbor statement on behalf of BEST Incorporated. Today's discussion will contain forward-looking statements. These forward-looking statements are based on management current expectations. They involve inherent risks, uncertainties, and other factors, all of which are difficult to predict and many of which are beyond the management's control. The company does not undertake any obligation to update any forward-looking statements as a result of new information, future events, or others, except as required under applicable law. Please also note that certain financial measures that the company uses on this call are expressed on a non-GAAP basis, such as EBITDA, adjusted EBITDA, and non-GAAP net loss. The GAAP results and reconciliation of GAAP to non-GAAP measures can be found in BEST Incorporated's earnings press release. Finally, please note that unless otherwise stated, all figures mentioned during the conference call are in RMB. Now I would like to turn the call over to Johnny Chou, Chairman and CEO of BEST Incorporated. Johnny, please go ahead.
Thank you, operator. Good morning, good evening, everyone. First, I'd like to apologize because the line has some problem. I'm sure some other people have the same problem too. So we're a few minutes late. I apologize. Welcome and thank you for joining our earnings call. In the first quarter of 2020, amidst the COVID-19 pandemic, we remained nimble, swiftly adjusted our services to meet changing demands, and aggressively managed the costs to navigate through these difficult times. We focused on several key priorities, including ensuring and prioritizing the health and the safety of our employees and customers, rapidly resuming operations, ensuring our strong balance sheet and liquidity, positioning ourselves for a more streamlined business and improving conditions, and finally, committing our resources to contribute globally to the fight against COVID-19. These efforts could not have been accomplished without extraordinary efforts of our employees, franchisees, suppliers, and partners. From the onset of this crisis, we have been functioning as a critical infrastructure business, leveraging our network to keep supply chains fluid. As far as BEST COVID-19 global relief efforts, I would like to mention just a few of the many examples. BEST Charities Foundation donated or helped to ship hundreds of thousands of masks to hospital centers in Thailand, Vietnam, and Malaysia. In addition, leveraging our own infrastructure, BEST coordinated the shipment of another hundreds of thousands of medical masks to Malaysia, which was donated by the China Youth Center for International Exchange. Finally, the BEST Charitable Foundation also sponsored the shipment of several hundred thousands of surgical masks to France. As I just mentioned about Southeast Asia, our delivery business in that region continues to accelerate as we build up momentum in Thailand, Vietnam, and expanded to additional countries. As we enter the second quarter, all of our business lines swiftly returned to normal operations, and I am pleased to report that the demand for our integrated supply chain and logistics services are robust as consumer purchasing habits have shifted deeply online. Our fundamentals are strong with continued high growth in e-commerce and an intense focus on increased operational efficiencies, all of which can drive improved profitability in 2020. And as the market continues to recover, BEST is well positioned and ready to help customers resume their businesses. From a balance sheet and liquidity perspective, our balance sheets remain strong with cash and cash equivalents, restricted cash, and short-term investments totaling over RMB 4.2 billion at the end of the quarter. Now let me share some insights on the business. First, our core logistics and supply chain units. Strategically, we continued optimizing our logistics network during the quarter by further improving transportation efficiency and automation, integrating our comprehensive logistics and supply chain solutions to create revenue and cost synergies, and enhancing overall quality of services. For Express, the first quarter is traditionally the quarter we have slower growth compared to other Express companies that remained open during Chinese New Year holidays. In the quarter, Express parcel volume decreased slightly by 1.9% year-over-year to 1.3 billion compared to 3.2% market growth-wide growth. The unforeseen decrease was primarily due to an over 1 month of delay of our workers and franchises to physically get back to their positions as a result of the pandemic. Extensive efforts were required to reopen facilities and allocate resources, and our operation only started to recover in early March. By end of March, operations had recovered to full capacity, and almost all workers and network partners are back on board. Our strategy for Express is to generate above-market growth, drive down unit costs, improve network stability, and enhance customer satisfaction. We plan to continue investing in automation and applying technology, all in an effort to improve productivity and efficiency, and then to ultimately increase volumes and the lower costs. In fact, our combined dynamic routing for Express and Freight has already yielded strong cost savings. For the last year, we have combined over 2,000 routes and saved over 130 million RMB. Our Freight business was also impacted in the first quarter. Slowdowns in manufacturing and 2B activities reduced the demand in the quarter. Like Express, the network recovered only starting in March. As a result, volume decreased by 15% year-over-year to 1.1 million tons. Pass-throughs of toll fee waivers to customers partially contributed to an 18% decrease in ASP. Cost per tons remained flat as the high cost incurred during the recovery period was offset by the government toll fee waiver. Since late March, the freight network has recovered and market demand has also picked up as the Chinese economy started to recover and the e-commerce transactions increased. Therefore, we expected a strong second quarter with much better ASP. Our strategy for freight is to continue strengthening our market-leading position by focusing on growing e-commerce related transactions, through which we expect to realize additional synergies with our other businesses. For BEST Supply Chain Management, while the pandemic impacted our 2B business, we saw a pickup in our 2C business due to increased demand for online shopping. The total number of orders fulfilled increased by 34.9% year-over-year. We expect the 2B volume to pick up as the economy continues its recovery. Strategically, we continue to focus on 1. Growing our franchise cloud OFC business with higher profit margins. 2. Accelerating integration with other business units to offer one-stop supply chain solutions to more customers and drive B2C orders growth. And lastly, leveraging our SaaS platform to digitize the supply chain of merchants. Next, let's discuss BEST Cargo. our fast-growing online full truckload brokerage platform, it was also impacted by the manufacturing activity slowdown and travel restrictions in the first quarter. The number of transactions decreased by 6.4 year-over-year. We are making progress on strategically shifting its business model from key account to channel and in making more transactions directly with drivers through UCargo app. The total number of drivers on the platform more than tripled to over 209,000 from a year ago. Our goal is to bring many more drivers directly onto the platform in coming quarters. In summary, our core logistics and supply chain units withstood the impact from the COVID-19 outbreak, and our plan is to stay on track for fast growth, as well as further improvement of efficiency, quality of services, and integration across business units. For Backstore Plus, as mentioned in prior earnings calls, we are in the midst of conducting a strategic review of the business for its next phase of development. In terms of the operations, we saw an increase in orders fulfilled for franchise and membership stores in the first quarter, which offset a decrease in orders fulfilled for self-operated store. The total number of orders fulfilled decreased by 4.6% year-over-year due to temporary store closures during the pandemic. Our strategy of focusing on branded stores and high-quality membership stores brought us better order structure and higher margin, enabling us to further leverage our competency in supply chain management and improve operating efficiency. In the first quarter, our gross profit margin improved to 13.3%. As the pandemic changes the behaviors of businesses and consumers, the store plus model is becoming essential as businesses go online for procurement and consumers rely on it for last mile services. For Vet Global, like Store Plus, we are also conducting strategic reviews of the business to drive its long-term growth and to capture the immense opportunities in Southeast Asia. While our cross-border e-commerce logistics business was impacted by pandemic, express business in Southeast Asia continued its rapid growth momentum. Parcel volume in Thailand increased by 96% quarter-over-quarter to 5.1 million, while parcel volume in Vietnam increased by 46% quarter-over-quarter to 3.7 million in the first quarter. We are contracted with top e-commerce platforms in both Thailand and Vietnam to provide cost-efficient and high-quality delivery services, which will drive further growth. In April, we also launched a nationwide express delivery services in Malaysia and Cambodia. In closing, despite the start of 2020 due to COVID-19, we are optimistic that we will finish the year strong and logistics, supply chain management become even more critical to business and consumers. As businesses go online and consumers demand increasing flexibility, they rely more on our smart solutions and efficient services, and we are more confident than ever of the path we are on to digitize and integrate the logistics value chain from end to end. In the second quarter, we have seen continued improvement in business recovery, which are helping our business segments to grow. We expect to get to improved efficiency and profitability for the second quarter. Now I would like to turn the call over to our CFO, Gloria, to walk you through our first quarter financials.
Thank you, Johnny, and hello to everyone. The challenges we faced in the first quarter presented us with an opportunity to take a more critical look at our business and improve our operations. By further streamlining our business, thinking deeper on how to be efficient, finding opportunities for cost savings, and further focusing on capital allocation and investing, we have fortified our competitive position and entered this recovery period even better prepared to scale and meet the increasing demand for integrated supply chain and logistics solutions. In the first quarter of 2020, the broad impact from the COVID-19 outbreak widened our net loss, as our business, along with associated costs, was negatively impacted by the prolonged work stoppage and the travel restrictions during the pandemic. Despite these factors, our balance sheet remains strong, and we are currently seeing a strong recovery and rebound. As the impact from the pandemic subsides, we are confident in the operating profitability of our core logistics and the supply chain business. I will now provide a brief review of our first quarter 2020 financial results. Given the limited time on today's call, I will be presenting some abbreviated financial highlights. I encourage you to read through our press release issued earlier today for further details. The first quarter revenue was 5.5 billion RMB, representing a 20% decrease from the same quarter of 2019. We incurred a non-GAAP net loss of 712 million RMB in Q1 compared with a net loss of 208 million RMB for the same period last year. Our operating efficiency was also impacted by COVID-19. Gross profit margin was a negative 3.2% compared with positive 4.3% of the same period last year. Adjusted EBITDA for Q1 was negative 580 million RMB compared to negative 79 million RMB of the same period of 2019. Our operating cash flow was negative 1.3 billion, primarily contributed by lower revenue resulting in a 712 million RMB loss, as well as net reduction of approximately 600 million RMB in receivables and payables. We expect operating cash flow to turn positive next quarter. Next, moving on to key financial highlights for our business units. On a year-over-year basis, Q1 revenue for BEST Express decreased by 21% to 3.4 billion RMB, primarily due to a 20% decrease in revenue per parcel. The drop in ASP was due to competitive market dynamics and the pass-through of temporary highway toll fee waivers to customers. Q1 total cost decreased by 16% to 3.5 billion RMB, and the cost per parcel decreased by 14%, mainly due to lower last mile transportation and labor costs, offset by the increase in fixed costs per parcel due to the pandemic. Adjusted EBITDA was negative 198 million RMB compared to positive 100 million of the same period of last year. The first quarter revenue for BEST Freight decreased by 31% to 684 million RMB year over year, primarily due to 15% decrease of freight volume and 18% decrease of ASP per ton, which was partially contributed by the pass-throughs of temporary toll fee waivers to customers. Adjusted EBITDA was negative 184 million RMB compared to negative 11 million RMB the same period of last year. The Q1 revenue for BEST Supply Chain Management decreased by 24% to 408 million RMB due to the lower ASP orders from franchise order fulfillment centers. Adjusted EBITDA was negative 34 million RMB compared to negative 8 million RMB the same period of last year due to increased costs associated with COVID-19. BEST UCargo Q1 revenue decreased by 14% to 381 million RMB year over year. Adjusted EBITDA was negative 28 million RMB compared to negative 20,000 RMB the same period of last year. BEST Capital's revenue remained flat compared to Q1 2019, while adjusted EBITDA was 21 million RMB, as we continue to provide financial solutions to our partners, franchisees, to assist them in accelerating their recovery from the pandemic. Store Plus' revenue decreased by 16% to 463 million RMB, primarily due to temporary closure of self-operated Walmart membership and franchise stores during the pandemic. Adjusted EBITDA loss was 78 million RMB compared to 75 million RMB the same period of last year. Q1 revenue for BEST Global increased by 183% to 116 million RMB as we continue strong momentum in Southeast Asia. Adjusted EBITDA was negative 64 million RMB compared to negative 22 million RMB from the same period last year, as we continue ramping up operations in Thailand, Vietnam, and launching new operations in Malaysia. Next, in terms of major operating expense items, compared to the same quarter of 2019, selling, general, and administrative expenses increased 25 million RMB to 485 million RMB from last year. The increase was due to approximately 27 million of one-time bad debt provision resulting from the adoption of new accounting principle, ASC 326, estimated credit loss, 10 million additional investment in our global operations, partially offset by the decrease of SG&A expenses from our core logistics and the supply chain business. R&D expense increased by 7 million RMB to 59 million RMB as we continue to invest in technology. Please note, all of these expenses excluded share-based compensation. We continue to control our SG&A expense and invest in R&D to improve our operating efficiency, and we expect operating leverage to expand as we recover from the pandemic. CapEx in the first quarter was 346 million RMB, or 6.3% of total revenue, compared to 206 million RMB of 3% of total revenue in the same period of 2019. As we are recovering from the pandemic and on the path of growing our business again for the rest of the year, we have initiated several cost efficiency improvement programs to streamline CapEx, reduce expenses, and conserve cash. For example, we started to optimize our capital investment in sortation centers and hubs by enhancing our design to maximize the usage of existing infrastructure and equipment. I should highlight that automation upgrade remains one of our priorities, and we are on track to expand our automated capacity. In addition, we continue to consolidate our warehouses and in a process of enhancing customer credit review procedures to avoid high risk and low profit business. We target a total savings of 100 to 100 million RMB from these initiatives in both CapEx and operating expenses in the next 12 months. Before we turn to Q&A, I would like to add that as the impact from the pandemic continues to subside and we enter into the recovery of our sector and affiliated sectors, we have ample liquidity, a strong balance sheet, and are keeping our focus on cost management. This fact, coupled with the continued upward growth trend in e-commerce both in China and globally, give us increased confidence in the long-term operating profitability of our core logistics and the supply chain business. With that, we will now open the call to Q&A. Thank you.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star then 2. At this time, we'll pause momentarily to assemble our roster. And our first question will come from Beiying Shi with Citi. Please go ahead.
Hi, morning, Johnny, Gloria.
Morning.
Hello. Hi, this is Beiying. So I actually have 3 questions to follow on. The first question is still on the express delivery business and mainly on the competition strategy. Because per my recent channel check, I actually noticed volume growth of us is slower than our major Tongda peers. It looks to me it's more like our intentional move. We want to control the growth pace and to focus more on profitability. But I just want to know if this is true. It's about our strategy adjustment for this year on competition with others. So to keep bottom line break even at the key priority for express competition. And Gloria, I'm sorry, my second question, I didn't hear very clearly on the OPEX and the CAPEX guidance. So how much would be the CapEx now? Because I see we are going to reduce some CapEx plan, and the OpEx is a 100 million RMB savings for the next 3 quarters. I'm not sure about this number. And my third question is regarding we mentioned there would be a potential spin-off of certain business units. Because we talked about this before, it's about the Store Plus business. Just want to know if there is an update on the spin-off plan, because this would be very important to our cash flow and also profits. So just want to have an updated plan on this too. So 3 questions. Thank you.
Okay, so Baoyin, I will answer the first question, and for Gloria probably can answer the second, and I will back to third. For the express delivery, and you also noticed that the market, the competition, it's also very heavy. So this year we want to more focus on our quality of services as well as profitability. So you're absolutely right. We want to maintain a market, in the previous years, many years and quarters, our growth is always much higher than the market growth. So this year we wanted to more focus on the quality of service improvement as well as the cost reduction, and to make sure the profitability is getting better. So the strategy is to maintain a market growth instead of a much faster than market growth, but meanwhile strengthen our competitiveness in terms of the quality, cost structures, as well as the profitabilities.
Yes. So, Baoyin, hi, how are you? This is Gloria. So I'm just addressing your question about OpEx and CapEx. So just, you're probably following the company for a while. The company has been growing very fast, in the past years. So with that such kind of growth, we actually did not really have a lot of time or opportunity to review a very detail of our operations. This pandemic actually gave us a very good opportunity to really talk about the cost, to review our costs and review detail of operations. So we have initiated several cost reduction or efficiency programs to enhance our operating expenses. So from those programs, we estimate we are able to save about 100 to 100 million RMB for the next 12 months. Then in terms of CapEx, investing in automation is still top of our priority. For this year, our plan is to invest 1.3 billion in CapEx.
Yeah, so let me just add a little bit more. So if you look at our SG&A, actually in the past couple of years, we really have been expanding our cost and structure, improving it by reducing a percentage of it. So if you look at our SG&A, basically it's not really increasing due to the growth in this. So because of the pandemic, it then looks like it makes as a percentage of revenue grows slightly, but in fact the absolute number is actually not growing. But this year we don't sharpen our pencil again to see, continue to see if we have able to sharpen more on the cost side, OpEx side, and the CapEx. Now CapEx still is very important because that's a part of our automation strategy. So we still can spend about 1.3 billion on that to make sure that we can continue to be competitive and also efficiency in our cost structure. The last question you had on the potential of the business reviews. Yes, we continue to conducting our business review. You talking specific about Store Plus. Actually, Store Plus it's doing pretty good in the last couple of quarters. If you look at the pandemic, actually our margin has improved from last year 12% to 13.3%. But meanwhile, we also, as we did a call mentioning in the last couple of quarters, that we will continue to look at strategically at our strategies. But unfortunately, I cannot give you really at this time to give you exactly more details until we have further to share in the next couple of quarters.
Okay, thanks, Johnny and Gloria. So one more follow-up on the Express. So it's kind of, I can relate it as we will keep the bottom line positive at least in the next 3 quarters for Express?
Wasn't very clear. Can you say one more time? I can't hear you very clearly.
So
you're talking about bottom lines?
The key priority for Express is to at least keep because the competition is quite intensive there. If we follow the peers' key competition strategy, our earnings will be hit heavily. So if we want to keep the bottom line positive, which means we may sacrifice the volume growth a little bit. But the key priority is to keep at least the bottom line or the EBITDA line positive for Express.
Yeah. So if you look at the last year, 2019 release on the quarter, we actually had a very good bottom line for the Express, even with the Chinese New Year on the first quarter. So first quarter, second quarter, third quarter, fourth quarter on the 2019, first quarter is also positive on the bottom lines. And before the pandemic, we did have a very high expectation that the 2020 first quarter is going to do even better than last year's first quarter. Last year's first quarter, we actually had about adjusted EBITDA about 100 million positive. So because of the pandemic, the first quarter we actually negative margin. So instead of a positive margin, last year we had positive margin of about 3%, and this year was about negative 3.7. So you in and out, and you actually have about 6.7% of your negative margin there. But looking at the second quarter or April or May, amongst the quarter today, then we are looking at recovery fairly quickly, posting volumes and profitability. So we're expecting second, third, fourth quarter it's going to be continue to improve back to the expectation of what we had planned for the last year. So full year, Express definitely going to be by itself is definitely going to be positive.
Okay, thanks, Johnny.
Yes.
Our next question will come from Thomas Chong with Jefferies. Please go ahead.
Hi, good morning. Thanks, management, for taking my questions. My question is on the Express side. Can management comment about how we should think about the trend in ASP and cost per parcel in the next couple of quarters, given the fact that we are seeing increasing price war, but we're also improving our efficiencies. So just want to get some qualitative color about the trend going forward. And my second question is about the overseas business. Can we talk about how the overseas online shopping is trending, given the overseas virus is breaking out? Thank you.
Yeah. Okay. Thank you. On the Express side, as I was just mentioned to the Baoying's question, so the second, third, fourth quarter, we are continuing to improve the margin. As you know, the last year, 2019, the full year, the Express for the second, third, fourth quarter grow consecutively from second quarter, third quarter, and the fourth quarter. Margin will be improving for 2019. We should expecting to see a similar kind of trend this year. So basically, the price, yes, as everybody knows, the pricing is very competitive, but also we have a lot of room to continue to drive down the cost. Specifically on transportation side, we can drive down more cost as volume increase, and we reducing some of the hubs and rerouting and combining the resources with the freight routing. That should give us a more cost reduction, as well as more infrastructure investment, capex investment. We also will improve our efficiency to the much higher level. So basically, we will see a continual cost reduction, probably around 10 to 15%, and we also will see the pricing also coming down. So what I'm trying to say is that we try to maintain similar or higher margins than last year from second quarter onwards. basically driving, by balancing the pricing as well as the cost reduction, so make sure that the margin and everything intact. That's the first question. The second question you were asking around about the overseas business. Yes, in Southeast Asia, and we see a tremendous opportunity because the e-commerce is growing very rapidly, especially during this pandemic. Actually, our business is growing in these countries because people are getting more online, and in the fact that the infrastructure is still somewhat lacking, not like in China, that in the past 10 years, both supply chain and express is all being very well developed. So there's quite a big opportunity there. So if you look at our Thailand, we basically, as I was saying, we grow about 97% quarter over quarter from last December, fourth quarter. Typical fourth quarter it's a high season, so even within the pandemic, our first quarter grew about 97%. Vietnam, same thing. We also grow about 47% quarter over quarter, so they're growing very rapidly. We see similar trends. The country we have also been in operation now in Malaysia and other and Cambodia. So the demand for e-commerce online and the last mile delivery and services supply chain are quite high. And the competition is not as severe in China, so there's a lot of opportunity there.
Thank you.
Our next question will come from Ronald Chung with Goldman Sachs. Please go ahead.
Sure. Thank you. Hi, Johnny. Hi, Gloria.
Hi, Ronald.
Two questions from my side. Yeah, good. First, want to see how your business recovery pace is going so far. I mean, the State Post Bureau numbers for parcel have been encouraging, for nearly over 30% parcel growth for the industry in the month of April. So very strong overall industry improvement. Just as you commented that your target is to grow in line with the industry, just want to hear, is our recovery pace so far already back to kind of industry growth levels, or is that a plan that for the rest of the year as we target to grow back in line with the industry? So some higher frequency trends of how you're seeing the recovery path so far. And then the second is on your cost reductions and unit costs. I could see that your unit trucking costs have come down significantly, actually to the lowest level that we've seen at around 69 cents of transportation costs. So that's actually quite similar to even industry leaders during the first quarter. Have we done? Just want to see what have we done in our trucking and our route planning that have brought rather good results in unit cost reductions, even despite the parcel kind of small decline over the quarter. And should we expect this new level of transportation cost cuts to continue for the rest of the year, which would be very encouraging? Thank you.
Thank you, Ronald. So the business recovery, we already in line with the market plan is basically this year, we wanted to focus on operational, the core of it, like you said, the cost reductions, service qualities and efficiency side. So far the recovery is in line. Hopefully the first quarter was a little bit lower because a lot of our peers, they did not close or rest for the Chinese New Year holiday, and that make them recovery much easier because they were never closed. There was in operation in service during the holiday, but nevertheless we and the other Tongdas, traditionally we all closed for Chinese New Year. So with the pandemic, recovery is a little bit difficult to reopen the facility, which was shut down. People travel, etc. It was a little more difficult. So first quarter was impacted, and I hope in second, third, fourth quarter we will recover and in line with the market development, and that certainly is our plan, and that's so far we have been keeping pace on that. Second, on the unit cost side, the unit cost the first quarter is actually a little bit, the numbers a little bit skewed, so cannot really being used as a because the number's lower, but it doesn't reflect it. For one thing is that in the first quarter, since late February to March, government basically has set up a rule so pass the toll fee for free, basically toll fee for free. And toll fee is quite a big chunk of the transportation cost, and that will overall lowering the transportation cost. Nevertheless, the reductions also, despite this toll fee pass, actually the cost for transportation during the first quarter is higher. The reason is that you cannot find a driver for the car, to drive the car or this. So you're basically paying twice or three times sometimes. So in long term wise, if you're looking forward to about the second quarter, which it seems at the beginning of May, the toll waivers already resumed the toll collection. So we will see but continually we see our transportation costs also much lower, around about 60 cents. So the cost reduction is real due to, I said about multiple things, right? Because one, the volume increase, other is the rerouting techniques that we are using. We have some project going on right now to see how we can improve the timing of delivery as well as reducing the cost of transportation, which is kind of related. So through the year we can see continue the transportation costs. The number you're talking about, 59 cents or whatever. We should see about close number on that on the second quarter, and third, fourth quarter we should be below that. We should see continue improve on that. Unit cost on the labor side, we are quite low already. If you look at our fourth quarter last year, it was about 21 cents. I expecting to be somewhat lower this year with more volume increase as well as the more capex and automation improvement on that. Other fixed costs were also coming down a little bit. So in line, I think we are confident 10-15% at least cutting in the operating cost side on the express side.
Sure, thank you. And is there a number of sorting hubs that you have now, the latest and target for end of this year?
Yeah, we were probably we kind of completed last year. So right now we have about 88, 90 sorting hubs. Another 18 or 20 is managed by our partners. I would hope we will cut down our self-managed to about 82. So some of the like Shanghai right now we have 3. We'll probably reduce to 2 this year. Maybe next year we'll reduce to 1, just maintain 1. Right now Shanghai we have 3 centers. And Beijing 2. Beijing we have before we have 2. Now we're cutting down to 1. And and some area we'll continue to looking at it. That will help us to actually make a better routing for transportation, reduce the cost, also timing as well. On the franchisee manager, the hub and sorting center, right now it's about 20 something. We'll cut down by half. So by end of the year. So totally we will cut maybe about 15, 10 by 5 managed by ourselves, and maybe about 10 managed by our franchisees.
Wonderful, thank you.
Our next question will come from Eric Zhong with Macquarie. Please go ahead.
Hi, good morning, Johnny, Glory, and management team. So this is Eric from Macquarie. Thanks for taking my questions. So I have a couple of questions. So first, regarding express delivery business, I want to ask about your capacity now, right? So do you mind share with us what's the optimal level of your capacity, like in terms of daily parcel volume right now in the second quarter, and how do you think that will actually continue to change towards the end of the year? So and also what's the average weight in the first quarter, and how does the trend look like in the second quarter and compare with the last year second quarter? And my second question is regarding freight, right? So if you look at the freight parcel ASP, that was down by 18% year-on-year. If we exclude last mile delivery fee, the decline will be more than 20% year-on-year. So I'm just wondering if this is a similar story to like express like a business. So or it's just a temporary change due to COVID. So what's the second quarter trend look like for freight ASP? Thank you.
Yes, Eric, thank you. As for capacity, all the company actually, the express company or Tongda, because we used to every year such a high growth, so every year we'll prepare for more capacity to aim for high season like fourth quarter, especially Double 11 and Double 12. So every year we will, we continuously actually it's a normal procedure of the work. Every week we have forecasting, planning to basically see which sortation center and hub will be run out of space or will run out of capacity that need to be rebuilt. So we start a plan. So every year we kind of outfit 30, 40 around about these facilities. So to make it either expand it or maybe make a bigger space. So as a capacity right now, but certainly our capacity right now, it's we stood last year's Double 11, Double 12. So it's based on the current level of the operation. So we still have room, maybe at least another 30-40% of the capacity. But with the whole year from beginning of the year to end of September or October, we're adding on another additional capacity to service on the November 11 and Double 11, Double 12 time. So to answer short, that typically we have about 70-80% capacity. So continue to build capacity by expanding our facility, adding more automations. Some hubs we have to move to making bigger rooms on that. So this is like the exercise we've been doing for past 5 years, 6 years. Like at the beginning of the year, every week, every quarter to see what's up. So answer short, 70% right now. But by end of the year we will continue to maintain about 70-80%. So what's by another 6 months we will add up another maybe 10,000 10 million capacities and for the Double 11 and then also for the early part of next year. As for freight, you well noticed, the first quarter, the ASP for the freight is lower than much lower actually. The reason is that as soon as the government announced the toll fee pass, the waiver of the toll fee, most of the company has reduced the cost and passed along this to the saving to the franchisees and helping them to recover. And as a result, some of them may pass to the end customers as well. So that's why you see a first quarter the ASP is a little bit lower. Fortunately, the freight industry is not as right now, at least right now, it's more and more concentrated from top few companies, and the pricing was not as severe as the express, because economic scale is not so obvious in the transportation, the freight business. They're still using a lot of forklifting and the manual labors versus a high automation systems for the express business. So for the second quarter on, I think from the second quarter on, you will see a continued recovery on the ASP side. And it might have by the end of the fourth quarter or by the later part of the year, second part of the year, it might have some drop from last year, but it's not going to be as this obvious from the first quarter. So the first quarter is low due to some special situation, COVID-19, and as well as some policies. But later part of the year, you will see ASP trend upwards. As a matter of fact, the second quarter will trend upwards. But nevertheless, it's going to be slightly lower than last year.
Okay. Thank you, Johnny. So just follow up on the weight for express business, right? So.
Oh yeah, sorry.
Yeah.
First quarter weighs about 1.25 to 1.29 to be exact. Because the first quarter typically it's going to be a little bit heavier than the other quarter. The reason is before Chinese New Year people buy a lot of things. The parcel packages typically are heavier. So the lowest weight time probably is like third quarter, summertime. The parcel are smaller. And towards the fourth quarter, end of fourth quarter, and the first quarter, the weight is a bit higher. So first quarter we got about 1.29.
Okay. Sorry about the second quarter trend. So are you observing for the second quarter weight in general?
Second quarter trend. You're talking about weight per parcel?
Yeah, weight. Yeah, weight per parcel.
Yeah, weight about 1.15 to 1.12. 1.15 to 1.2. I'm sorry.
Okay. Thank you, Johnny.
Again, if you have a question, please press star, then 1. Our next question will come from Hans Chung with KeyBank. Please go ahead.
Hi, good morning, Johnny, Gloria. Thank you for taking my question.
Good morning.
So I have 3 questions. Yeah. So first one, it seems like the recovery looks good, right, in second quarter, and then but why we still don't provide guidance? And then I know there might be some uncertainty, but exactly where do you see the uncertainty come from majorly in the near future? And then our second question would be the store business, and then as we have seen the procurement moving to online, and then I just wonder, is that a structural change because of the COVID-19, or is kind of temporary? And what's our observation, like particularly into the April or May, is the people still procure online versus offline? And then last one is the global business. Is there any near-term impact on the global side? Because I think the COVID-19, it's kind of, the worst case is kind of later than the China, outside China region. So I don't know if there could be some near-term impact in the second quarter. And then longer term, what kind of the margin profile for that business? And then what kind of trajectory to profitability? For example, like we now see in 1Q, we have the negative over 30 million gross profit. And then is that are we going to see the narrowing gross profit or on the margin percentage level, or just it could be continue to be larger? Thank you.
Yeah. Okay. Thank you. The first question is the guidance. The second quarter has recovery is strong, but nevertheless we still see some of these market dynamics in terms of pricing and all this. Still some uncertainty there. So we really want to be more comfortable to give a good guidance. So you probably will see in next quarter something we'll probably give as things are more settled. Probably will give a current trade just like like you asked. I think there's some sort of uncertainty mainly due to like market dynamics and also recovery. Even though strong, but we still see some uncertainty there. So yeah, so we will try to give a guidance as soon as we feel that things are getting to control and everything else is under better certainties. And move on to Store Plus. Actually, Store Plus, we had overall had to reduce the cost, and more is moving online. As in fact, we're seeing a lot of the traditional resellers, the distributors, and they're also working with us and try to moving their business online as well. That's where you see a pretty strong movement on the Store Plus side, integrating the last mile in the supply chains, both for the warehousing, delivery, as well as procurement. So on that, in fact, our release, our first quarter Store Plus actually has an actual loss than last year, even though we said we had 78 million, but 70 million actually we put R&D and all the other functions, HR, finance, all functions, the expenses into that versus last year, we did not separate these expenses. So if you look at the apple-to-apple comparison, there's actually a lot less losses for the Store Plus. So the moving online to is real. We see more and more the merchants on the end of to be percentage of the retail is generated online. So also the orders is online. So that is looking at global on the COVID-19 impact. Yes, our cross-border business was down 50%. So cross-border business, that meaning is that we shipment to the U.S., shipment to the Middle East and Europe, and that's obviously is all being impacted in and out. But we see a strong domestic expansion. Domestic expansion, when I look at the Thailand, for example, Vietnam or Malaysia, actually during the first quarter and even April, May, now online is going fairly strong. So as in China, people staying home, so they buy more and more things online, and that's what our business are. Of course, border is impacted because we did have a lot of business of cross border to shipping things import and export for the supply chain materials to the globally, and that's impacted. Yeah, but right now our strategy is really global business strategy is really focused on developing the local service network like we did in China for express and these services. So on the margin side, as you can imagine, you enter into a new country. Initially, you would have to spend some money to build a sortation center, build all the infrastructure and everything else. Will be, but if you look at Thailand, look at the Vietnam. In fact, the second quarter, the margins are improving much better than the first quarter. So as the volume goes up, we can see a similar trends like in China, margins going to improve. So we are confident, the margin improvement as the volume goes up will be, a break even in the next couple years.
Thank you. That's helpful.
Okay, Hans? Anyone else?
Yeah. That's helpful. Thank you.
Okay. Operator? Hello?
Hey, sir, we're showing no further questions at this time.
Okay, so thank you very much. That's our, with that, we will now, thank you very much for joining our call, and we'll talk to you very soon. And hopefully, if you have any more questions, you can contact our IR teams, to get more colors on that. Thank you very much.
And we thank you, sir, and to the rest of the management team for your time also. The conference call is now concluded. At this time, you may disconnect your lines. Thank you again, everyone. Take care and have a great day.
Thank you, operator.